Good morning, all. Thank you all for joining on this Saturday morning. The topic for today is large cap comfort versus mid and small cap for growth, where you should invest in 2026, 27. So, the reason for doing this topic uh, for this webinar is that a lot of us are confused on which segment to invest because of the corrections and the volatility that is happening right now in the markets. There is no uh, visibility or clarity in terms of where you need to invest and where you need to stay allocated majorly in equities. And a lot of people are even, you know, are very doubtful on if they need to invest in equities or they should just redeem all their money and just have a wait and watch game. So if you have these kind of questions, I hope today's webinar will be useful for you. So now let's just quickly get started. So generally, how does small caps and large caps behave? So typically, uh, you know, large and small caps or even mid caps don't move in the same way, be it in a bear market or bull market in terms of returns. Uh, the difference will be in returns volatility. So if you take small caps, for example, they have long periods of underperformance, and when they start moving and when they start giving returns, the returns will be in a very short span of time. Let's say 20, let's take 2023 for example. It just happens like that. So the returns are very lumpy. There will be phases of years where there will be no returns for 12 to 24 months, and after that, within a short period of time, you will get very good returns by compensating for the first initial 20, 12 to 24 months returns where there was no returns. So to summarize, the returns generated are in a very limited time window. So the timing of investment, when to buy and when to exit is very difficult in small caps actually. Whereas if you take large cap, for example, it's totally in contrast. So the compounding is more stable. There is some visibility over earnings, and even the volatility is minimal when you compare it to a small cap sector. And the returns are quite consistent. So these are the difference over small caps when you take large caps actually. So the main thing here is that uh, just as the stock selections, the exposure to large, mid, small cap also matters actually, because at the end of the day, it's all capital allocation and capital rotation, right? So, do small caps consistently deliver higher returns? This is just a myth that everyone keeps believing, especially the people who entered in the last 5 years after COVID 2020. So now let's just take three time frames. So when you take Jan 2018 to March 2021, the CAGR for this time period was 11% in large caps, and small caps it was negative returns actually. And if you take April 2021 to March 2024, the small cap returns was 25 to 25%, 27% compounded annual growth, and large caps it was 15% CAGR. So in current phase, both the segments, have been delivering muted returns. The markets have been stayed flat in the last 16 months, right? So this clearly shows that in small caps, the returns will be in a different phase, whereas when you compare it to large caps, so you should know when you need to stay invested in large caps and when you need to, move your capital to small caps. So a lot of people question this, or they think small cap investing is easy. But let me just tell you why small cap investments is quite difficult and uncomfortable as well. So volatility generally is quite consistent. It won't be a very easy or a one-way line. You need to endure a lot of volatility in the space, and they don't give returns consistently. So they, like I said, they follow a phase where there will be no returns or there will be negative returns. Then there will be phase where the returns are very exponential, and there is high chance that a lot of small caps can correct 25 to 30% every 2 years. It is happening even right now. Even last year during the April 2025, due to tariff issue, a lot of small caps corrected by 20-30% easily, and even last month a lot of small caps corrected by 30-40%. A lot of small cap stocks have corrected, and even the index went down by 20%, right? So a lot of high chance that your portfolio goes down significantly during downturns, and there is a very sharp catch up after volatility. So the timing is extremely difficult in small caps. So you need a lot of stomach to, have a very high conviction when you go invest in a small cap, and you need to have a high stomach to endure that volatility and stay invested. So generally, like I said, investing in small cap requires a 5 to 7 year mindset actually. A lot of people generally, they say they have the ability to hold for 10 years. That's why I'm taking a high risk and I'm investing in small cap. But generally, when they when they see through a 30-50% drawdown, definitely everyone, exit. Some people might even hold on to a minus 30-40% drawdown, but once it recovers, they just take their capital back without any loss, without making any loss. But there will be a high chance that the stock might even start performing after that stage. So a lot of people are not experienced to hold or invest in small caps during their first cycle. So that is what our general advice is. And a lot of people think that they can time it easily, and they can, invest point to point, but that's really not possible. Nobody can, predict the bottom. So ensuring that you deploy your capital in a staggered manner is a right way of investment. And additionally, valuations always do not move in line with earnings, and your selectivity is very crucial. And only a very few fundamentally strong companies create outsized value, and you need to make sure that you find the correct company and you take an outsized bet in order to make good amount of money, which is extremely difficult. So now let's just uh, see the overall picture in mid caps. So mid caps during January 18 to March 2021, they delivered Nifty 50 delivered 11% CAGR, and Nifty mid cap delivered 7%. And April 2021 to March 24, uh, Nifty 50 delivered 15%, and Nifty mid cap delivered 25%. And from April 2024 to till date, Nifty 50 has delivered 3%, and Nifty mid cap has delivered 8%. So mid caps has shown a good stability in terms of this macro issues going on, but the main reasons have been a good amount of inflows into mid caps and flexi cap funds. Because when you even compare large caps or even small caps, the valuations are quite elevated in mid caps when you compare to large and small caps actually. And the universe is very limited to a very narrowed 150 companies. So these valuations have been supported by steady flows. But one thing you need to keep in mind that uh, everything won't work out the same way. There might be a turnaround when the inflows start uh, reducing, and eventually every segment will face corrections. The So another thing people need to keep in mind is that they think corrections are rare events, but it's really not. Corrections are something. Volatility is something which keeps coming consistently when you invest over a period of time. Let's take 2018 for example. In 2018, the government, the SEBI the AMFI changed the classification of large, mid, and small caps. They classified that only the top 100 companies by market cap will be large cap, and the top 100 to 150 will 250 will be mid cap, and 250 to 500 will be small cap. After 500 will be micro cap. So during this phase, the market corrected by 40-50%, and around COVID, it's an unpredictable event. And June 22, during the Russia war, the markets almost corrected by more than 25%. And during April 2025, uh, during the tariff issue, markets corrected more than 15%. And currently, due to this Iran war, the markets have also corrected more than 20%. So one thing you need to keep in mind is corrections are inevitable. So one thing that which is quite guaranteed is that when you deploy capital during times like this with the time frame of 3 to 5 years, you can definitely create alpha. And definitely nobody can time the market. Let's say, for example, it really doesn't matter that if you missed uh, the last month's correction. Yes, markets have almost gone up by 10%. Now it has started correcting, and still even Nifty is at fair value. So still you can invest your money in a staggered manner. So your participation, you know, participation and execution is really matters. The exact timing doesn't matter actually. So what happens after flat markets? So when you say, let's take an example actually where markets have stayed flat for around 18 months, and let's look what happened to markets after the 18 months of drought, the next 3 to 5 year or next 12 months and 36 months returns. So when you see uh, like 31st July 2001 to 31st December 2002, the 18-month return was 1.92%. Almost markets was flat. There was no returns in the Nifty 50. But the next 12 months, the next 1 year, the markets delivered around 72%. And the next 3 years, the markets delivered around 159%. And let's take, you know, the recent example of September 2021 to February 23. Markets Nifty delivered minus 1.78%. And after that, the returns was 27% in the last 1 year. And in the next 3 years, markets went up by 48%. And let's take October 21 to March 2023. The markets delivered minus 1.76%. The next 12 months return was 29%, and the next 3 years return was 47%. So this data highly shows that the next 12 to 36 months you will see a good amount of returns in Nifty 50, which is the large cap space, and that is the reason why we are positioned more towards large caps, which offers comfort and there is a which gives a more risk reward uh, play. So what is driving corrections? Like you all know, the main reason are the tariff disputes and the geopolitical tensions and a quite amount overvaluation in Indian markets even after this correction. So, uh, whatever reasons the corrections may happen, the outcome is always similar. Generally, due to these reactions, the markets fall and eventually they recover. Maybe, like I was showing the last data, right? Maybe markets might take even more than 12 months, but eventually it will recover. That's how the market cycle works actually. So, to summarize, generally small caps are structurally volatile, and in small caps the drawdowns are quite deeper, even more higher than index level. Because when you invest in small caps, uh, doing direct equity rather than mutual funds uh, or index funds, you know this pain. Your drawdowns might be even more higher than what a small cap fund or a small cap index goes through. And right now, you all know the FIs are quite negative on Indian market, and they've been net consistent sellers over a few months, even in large caps. And there is a lot of negativity around the Indian markets. uh, like most of the news are uncomfortable. There is no returns. The returns are quite flat, and the overall market sentiment is on a fear mode. But historically, during these fear phases, have laid the foundation for the next bull run and for your compounding. So you cannot wish that volatility doesn't come, but you need to have a mindset to make use of this volatility so that you capitalize on these opportunities and invest in good companies at a cheaper valuations. So definitely, this is not a time to withdraw from equity participation. It doesn't really matter if you miss the bottom. Participation at these levels will definitely get you good amount of returns in the next 3 years time. So you need to disciplinely, create a framework, and you need to, keep investing in correct ideas in a risk-free manner. And like phases like this have often become a powerful, compounding window that for the years to come. So thank you all for joining on this Saturday morning.